The price of Brent crude oil declined from a normal $68 a barrel at the end of 2019 to $14 a barrel in April 2020 as the COVID-19 pandemic spread worldwide. 2 years later, in March 2022, the price soared to $133 a barrel after Russia invaded Ukraine. Now it is falling again amid growing fears of a recession in the U.S. But the price could rise sharply if the Chinese economy bounces back from the stupor induced by its zero-COVID policies. Oil prices have been incredibly volatile over the last few years, with prices soaring and then crashing seemingly overnight. Just in 2022, the WTI crude benchmark peaked at $123.70 per barrel in March and fell to $71.02 per barrel in December. The outlook for oil in 2023 is exhibiting similar volatility. Take two articles published on oilprice.com for instance. Both have only been published 2 weeks apart but bear the following titles: $100 oil to return in 2023, and the upside for oil prices is limited. While it's impossible to predict the future with complete certainty, the Ukraine war and post-COVID economic recovery have made it even more difficult for investors to anticipate where prices will go next. Despite all this, however, I'm still bullish on oil overall and believe that over the course of the next few years, it could be a smart move for investors looking to make money trading commodities. Here I'll take a look at why I think oil prices are headed up in 2023, and what investors can do to capitalize on the trend. As they do in all markets, supply and demand play a critical role in determining prices in the crude oil market as well. Price is directly proportional to demand and inversely proportional to supply. The global economy is recovering from COVID-19, which bodes well for demand. China, a sizable economy which was slow to loosen up on its zero-COVID policy however, has seen a surge in the cases of COVID since it loosened restrictions. This will likely slow down Chinese citizens' return to normalcy, at least in the short run, and also affect global recovery, given the sheer size of the Chinese economy. Despite this however, global oil demand is higher than it was pre-COVID. In September 2022, it was 1 million barrel per day higher than it was in September 2019. Growth in demand was driven by the consumption of diesel in China and the demand for gasoline in the US. At the same time, global crude production was lower by 84,000 barrels per day than it was in September 2019 and global inventories remain 442 million barrels below the 5-year average. The Russian war on Ukraine has and will also affect energy markets around the world. As Russia is the third largest producer of crude oil worldwide and accounts for over 12% of global production. The war and the subsequent sanctions imposed by many countries on Russian crude as a result of it, have disrupted the market for crude and increased price volatility, at least for the foreseeable future. Additionally, OPEC Plus has implemented production cuts as a result of the uncertainty surrounding the global economy and the outlook for the oil market. This could lead to further price increases if supply stays tight while demand rises. In the long term however, I believe that global supply will be the single most important factor in determining overall oil price. This, in spite of the face that there is currently an active global effort, that has only sped up in the wake of the energy insecurity Europe has had to face in the wake of the Ukraine war. To move away from fossil fuels towards renewable energy sources such as solar, wind, geothermal, and hydropower. This is because global oil supply will fall in the years to come much faster than the demand for fossil fuels will shrink as the world moves towards renewable sources of energy. Many oil wells have peaked while others are due to peak soon. Existing oil wells are quickly becoming depleted and current supplies are only enough to meet demand for another few decades. While new wells in developed reservoirs can be made functional within a matter of months. Timelines for developing new fields span years because crude oil exploration requires complex permits along with the construction of pipeline and storage infrastructure. According to a study, the world's largest oil fields became active on average 5.5 years after initial discovery and took 17 years of production before they reached peak output. Drilling for fossil fuels is also extremely capital intensive, especially in the case of the more productive offshore wells that can cost upwards $120 million per well to construct. In addition to this, investment in new oil and gas wells has been limited since before the COVID pandemic even began as a result of global initiatives to move towards renewable energy sources in the face of growing climate concerns. The World Bank, for instance, no longer finances the exploration of fossil fuels. In spite of this, however, a feasible transition plan to phase out reliance on fossil fuels is still lacking, especially in the United States and Asia. As they did in 2015 when the Paris Climate Agreement was adopted, fossil fuels still account for 80% of global energy consumption. For the moment, oil and gas prices seem likely to remain elevated, despite fears of a recession in the US and Europe. as the Northern Hemisphere's summer driving season gets underway. And with the Chinese economy potentially rebounding from zero-COVID lockdowns, it is not difficult to imagine energy prices continuing to rise, even if the Federal Reserve's interest rate increases sharply curtail U.S. growth. In the longer term, energy prices look set to rise unless investment picks up sharply, which seems unlikely given current policy guidance. Supply and demand shocks will most likely continue to roil the energy market and the global economy. Investors who want to capitalize on rising oil prices can do so by investing in stocks or ETFs related to the industry, such as companies that produce or refine oil or provide services related to drilling and exploration activities, or through commodities futures contracts. It's important for investors considering any of these strategies to understand both the risks and rewards associated with them before making any decisions about investing their money in this sector of the economy. Overall, I'm bullish on crude oil, which I believe has the potential to generate strong long-term returns on investment, if, as in the case of all investments, investors are willing to accept some risk along with potential rewards. With global demand increasing and supply shrinking, many analysts that are looking a little further into the future predict that oil prices will continue to go up in 2023 and beyond. As always though, what I've written is purely my personal opinion, and it's important for you to conduct your own research into specific investments before committing your funds so you know exactly what you're getting into, and how much risk you're taking on when investing in any particular asset class or sector of the economy. If you made it this far, thank you for your time. Follow me and subscribe to stay with me in future videos mostly on investing, finance and the economy. If you have any investing topics that you'd like for me to cover, please drop them in the comments below.